You're welcome to my channel. In this video, we are going to be looking at taxation for branches. Yeah. So taxation for branches. A branch, it's like another part of the company that is somewhere else. Yeah. So non-resident companies, including a branch in Uganda, they are taxed on income derived from sources in Uganda at a corporation rate of 30%. So they are taxed at a corporation rate of 30%. They are taxed at a corporation rate of 30% after deduction for tax allowable expenses. Yeah. Then the non-resident companies operating a branch in Uganda would be required to submit annual self-assessment tax returns to URA and pay corporation tax. And then in addition to that, branches are subject to branch profits tax at a rate of 15% on repatriated income. So branches pay the corporation tax of 30%, and they also pay a tax of 15% on their repatriated income. Repatriated income is that income that is sent by foreigners to back to their home country. They earn it from here and then they send it back to their home country. It's what they call repatriated income. So they are charged a rate of 15% on repatriated income for a year. Yeah. Then repatriated income is computed using this formula. A plus B, A plus into brackets B minus C, then into brackets minus D, whereby A is the net assets of the branch at the beginning of the year, and B is the net profit. Here it is the net assets, then B is the net profit of the branch for year of income determined using the generally accepted accounting principles, and C is the tax payable. The tax payable on the chargeable income of the branch for the year of income. Then D is the net assets of the branch, but at the end of the year of income. A is net assets at the beginning, D is net assets at the end. Then C is tax payable, and B is net profits. Yeah. So that is the introduction about taxation for branches. They pay corporation tax of 30%. Yeah, and then branches, they still pay 15% on repatriated income, and this is the formula for calculating for repatriated income. Yeah, so let's have an example. An example, it says ABC Limited, an oil field company incorporated in Netherlands, is operating a branch in Uganda. On 1st January 2019, the cost base of the branch assets was Ugandan shillings 600 million. So on 1st January 2019, the cost base, so the net assets of the branch at the beginning of the year is 600 million. Then the net profit of the branch for the year ended 31st December 2019 was 110 million. This is the net profit. Net profit is this. Then, and tax payable was 30%. Then the cost base of the assets at 31st December 2019, so the cost base of the assets at the end of the year is this. So required, they want us to calculate the repatriated income of the branch. They want us to calculate the repatriated income of the branch and then tax payable on the repatriated income. Yeah, so our formula for calculating for repatriated income, that was given, it's A plus B minus C minus D, whereby A is net assets at the beginning, B is the net profit, C is tax payable, D is net assets at the end. Yeah. So the tax payable, this C, we calculate it by getting 30% of net profit. Yes, since we say that branches pay 30% corporation tax. So 30% of net profits, and the net profits that were given in the question, it's going to be 110 million. So 30%, 30 out of 100 times 110 million. It has 7 zeros. Yeah, so you just come here and write 1 and then on the calculator here where there is express here E. Yeah. The E puts itself there, then you put in the number of zeros, 7. Yeah, so it is 110 million. Like that. So 30% of 110 million is 33 million. So it's what we have here. It is the tax payable. Yeah. So after that, we go on repatriated income. This is our formula: A plus B minus C minus D. Yeah. A is the net assets at the beginning. It was given here in the question. Here, 600 million. So 600 million, then plus. B is the net profit. It's here, 110 million. So you write 110 million minus the tax payable, which is this one, 33 million. Then minus D, which is the net assets at the end, this one. Minus that. Yeah. So you first subtract this minus this, which is 110 E7 minus 33 million with 6 zeros. It is 77 million. So it's what is here. So 600 plus 77, then minus 535. Yeah. So 77 plus 600 million, which is plus 6. It has 8 zeros. E8. So 677 million minus this 500 minus 535. It has 6 zeros. So 142 million is the repatriated income. So the repatriated income is 142 million. But they told us calculate the repatriated income of the branch and the tax payable on repatriated income. So here is the repatriated income. So we need the tax payable on repatriated income. Yeah, and according to our notes, they say that the tax rate on repatriated income is 15%. Yeah, so we shall come here and then say 15% times the repatriated income. So here is the repatriated income, then times 15 out of 100, which is 21,300,000. So it is the tax payable on repatriated income. Tax payable on repatriated income. It is this one. But in case you want to get the total tax payable, you get this tax of 30% plus the tax on repatriated income to get the total. But it was not asked. Yeah, this plus this. Yeah, but this is what they asked for. Tax payable on repatriated income is this, and this is the repatriated income. Yeah, thanks for watching. Don't forget to subscribe, like, comment, share with your friends, and let's catch up in my next video.